Welcome back to another video lecture of financial market and instrument. We are discussing about the mutual funds, and we come to know that mutual funds are actually offering one of the most simple, comprehensive and flexible form of investment in which the asset managers are diversifying the investment of the investors in the suitable avenues according to the type of risk or the type of structure or the many different aspects or based that the investor is looking for. So the investment that the investors are doing in mutual funds could be of various types. There are various types of mutual funds, and we had briefly gone into the types of mutual funds in our previous classes. Today we will vividly discuss on those types of mutual funds. So in today's class we are going to read on the types of mutual funds in detail. So without much delay, let's start the class of today on the types of mutual fund. So as we know, there are several types of funds offered by the asset management companies, and these types are on various categories. We have been categorized, and we are going to discuss that one by one. First, we will be discussing the types of mutual funds based on the structure, and on that we have the three different types of mutual funds, that are the open-ended funds, the close-ended funds and the interval funds. Now what is this open-ended fund? These open-ended funds in which units are open for purchase or redemption throughout the year, that is what the open-ended funds are. All purchases or redemption of these fund units are done at prevailing NAVs, that is net asset values. Basically these funds will allow investors to keep investment as long as they want it to be there, and there are no limits on how much can be invested in these funds, and they also tend to be actively managed, which means that there is a fund manager who picks the places where investments will be made, and these investments also charge a fee which can be higher than passively managed funds because of the active management, and they are an ideal investment for those who want investment along with liquidity, because they are not bound to any specific maturity, which means that investors can withdraw their funds at any time they want, thus giving them the liquidity they need. So that is what the open-ended funds is, which is open, or we can say there is highly flexibility of these funds, and the investors have the free hand to withdraw that at any time they want. So this is what the open-ended funds are. Next is, we are having this close-ended funds. So if you see, these close-ended funds in which the units can be purchased only during the initial offer period, and these units can be redeemed at a specified maturity date. So to provide for liquidity, these schemes are often listed for trade on a stock exchange. And unlike the open-ended mutual funds, once the units or stocks are bought, they cannot be sold back to the mutual fund. Instead, they need to be sold through the stock market at the prevailing price of the shares. So that is what is the thin line between the open-ended and the close-ended funds. Next, we are having the interval funds in the other type of the mutual funds that we are categorizing on the basis of the structure, and these are the funds that have the features of open-ended and the close-ended funds, in that they are open for repurchase of shares at different intervals during the fund tenure. And the fund management company offers to repurchase units from existing unit holders during these intervals. So if unit holders wish to, they can offload shares in favor of the fund. So that is what the interval funds are. So if you see these mutual funds on the basis of structure could be of three types, that are the open-ended funds, the close-ended funds and the interval funds. As we have already seen that the open-ended funds had the high liquidity base, and investors at any time can go for withdrawal of or liquidation of the funds, and in close-ended funds which is traded on exchanges had some limitations that are being imposed by the asset managers. And the interval funds, which is having both the blend of the open-ended and close-ended fund, are the three mutual funds types on the basis of the structure. Apart from that, we have other types of mutual funds on the basis of assets, that are the equity funds, debt funds, money market funds and balanced or hybrid funds. So these are the four types of mutual funds that we are categorizing on the basis of the asset class. So what this equity fund is, if we'll see, these are funds that invest in equity stocks or shares of companies, and these are considered high risk funds but also tend to provide high return. And equity funds can include specialty funds like infrastructure, fast moving consumer goods and banking, other avenues or specialty funds that are included in this equity funds. If we see the next type, that is the debt funds, these are funds that invest in debt instruments, for example you can say company debentures, government bonds and other fixed income assets, and they are considered safe investments and provide fixed returns. And these funds do not deduct tax at source. So if the earning from the investment is more than 10,000 rupees, then the investor is liable to pay the tax on it itself. So that is what the debt in funds are. Then we have money market funds. These are the funds that invest in liquid instruments, for example the treasury bills and CPs, etc. They are considered safe investments for those looking for immediate but moderate returns. Money markets are also referred to as cash markets, and some with risk in terms of interest risk, reinvestment risk and credit risk, etc. Apart from that, the other type of mutual fund that we are having on the basis of the class of fund is the balanced or the hybrid fund. So these are funds that invest in a mix of asset classes, and in some cases the proportion of equity is higher than debt, while in others it is the other way round, and risk and returns are balanced out this way. So for an example, if you see of a hybrid fund would be Franklin India Balanced Fund DB, because in this fund 65% to 80% of the investment is made in equities and the remaining 20% to 35% is invested in the debt market. So it is a mix of, or it is a blend of both the equity fund and the debt fund. That is why it is called as a hybrid fund. So these are the four types of mutual funds on the basis of the asset classes that we are having, or that is available with the asset managers or the fund managers or the asset management companies on the basis of fund classes. And that we are having the debt funds, the equity funds, the money market funds, or the balanced, or what we are saying the hybrid funds. So in that we are investing on the type of funds that is available, like in equity funds we are investing in some equity shares, and there is high risk and high return in that. If we are likely to go for high risk and we are expecting a high return, then we can go for equity funds. So these are the type of mutual funds on the basis of fund that is available for the investors. Apart from that, we have other types of investment on different other bases, that are the type of mutual fund based on investment objective. So what is the objective of our investment? On the basis of that, we have different mutual fund types, and that are the growth funds, income funds, liquid funds, tax saving funds, capital protection funds, fixed maturity funds, and pension funds. So these are the various types of mutual funds which we are having or which are available on the basis of the investment objective. So on the basis of the objective of the investor, these are the types of mutual funds. So under the investment objective basis, the types of mutual fund that we are having, like the growth funds. So in growth fund, we are having the schemes, that is the money is invested primarily in equity stocks with the purpose of providing capital appreciation. So for the purpose of capital appreciation, if we are investing or we like to invest, we may go for these growth funds, and they are considered to be risky funds, ideal for investors with a long term investment timeline. Since they are risky funds, they are also ideal for those who are looking for higher returns on their investments. And the next type that we are having is the income funds. If you will see, under these schemes, money is invested primarily in fixed income instruments. For example, you can say the bonds, debentures, etc., with the purpose of providing capital protection and regular income to investors. Next, we are having the liquid funds. Under these schemes, money is invested primarily in short term or very short term instruments. For example, the treasury bill and CPs, etc., with the purpose of providing liquidity, and they are considered to be low on risk with moderate returns and are ideal for investors with short term investment timeline. We also can have these tax saving funds that are there in mutual funds, and these are funds that invest primarily in equity shares, and investments made in these funds qualify for deductions under the Income Tax Act, and they are considered high on risk but also offer high returns if the fund performs well. So these are what the tax saving funds are. Apart from that, we have capital protection funds. So these are funds where funds are split between the investment in fixed income instruments and equity market, and this is done to ensure protection of the principal that has been invested, and that is what the capital protection fund is. We also have fixed maturity funds, and these fixed maturity funds are those in which the assets are invested in debt and money market instruments where the maturity date is either the same as that of the fund or earlier than it. So that is what the fixed maturity funds are. Apart from all this, what the other important type of mutual fund on the objective of the investor is the pension fund, and these pension funds are the mutual funds that are invested in with a really long term goal in mind, and they are primarily meant to provide regular returns around the time that the investor is ready to retire, and the investments in such a fund may be split between equities and debt markets, where equities act as the risky part of the investment, providing higher return, and the debt markets balance the risk and provide lower but steady returns. And the returns from these funds can be taken in lump sums as a pension or a combination of the two. So that is what a pension fund is. So if you will see, on the basis of the objective of the investment, we might have different types of mutual funds, as we have discussed. That might be a growth fund, that might be an income fund, that might be a liquid fund, that might be a tax saving fund, that might be a capital protection fund, a pension fund, or a fixed maturity fund. So there could be this number of types of types of mutual funds that are available on the basis of the objective of the investor. That means what is the objective of the investor? According to that, the asset manager or the asset management company is having the type of mutual fund to offer them. If we are an investor and we like to appreciate our capital or growth in our capital, we may go for the growth fund. If we want capital protection, we might go for income fund. If we want it for a lump sum basis of a pension fund, can be a type of mutual fund. If we are trying to have a blend of, or we are going to have a moderate return with taking a calculative risk, we can go for the fixed maturity fund. And if we are planning to have tax saving investment schemes, then also we can go for tax saving fund schemes. So these are the various types of mutual funds on the basis of the investor's objective. Apart from that, we have different investment plans with the mutual fund managers. Those are based on many spatial aspects that are based on specialty, we can say. On that, we have different mutual funds like sector funds, index funds, fund of funds, emerging market funds, international funds, global funds, real estate funds, commodity focused stock funds, market neutral funds, inverse or leveraged funds, asset allocation funds, gilt funds, and exchange traded funds. So these could be the various types of mutual funds basing on the specialty function that they are doing or providing. So what are these? Let's have a look on that. Like, first we will discuss on the sector funds. So these are the funds that invest in a particular sector of the market. For example, if you will say the infrastructure funds invest only in those instruments or companies that relate to the infrastructure sector. So these are the sector funds. So the returns are tied to the performance of the chosen sector. And the risk involved in these schemes depends on the nature of the sector. So when we are talking of the sectoral funds, these are the mutual funds based on a specific or spatial sector on which the investor is likely to invest in, or the investor is willing to invest in, and the return is completely depend on the performance of that chosen sector. Next, we are having the index fund, and these are the funds that invest in instruments that represent a particular index on an exchange so as to mirror the movement and returns of the index. For example, we can say the buying shares representative of the BSE Sensex. So on the index, if we are making an investment, so that is what the index funds are. We have funds of fund in these specialized mutual funds, and these are the funds that invest in other mutual funds, and returns depend on the performance of the target fund. So these funds can also be referred to as multi-manager funds, and this investment can be considered relatively safe because the funds that investors invest in actually hold other funds under them, thereby adjusting for a risk from any one fund that is available with there. Then we have emerging market funds, and these are funds where investments are made in developing countries that show good prospects for the future, and they do come with higher risk as a result of the dynamic political and economic situations prevailing in the country. And we have international funds in that. These are also known as foreign funds, and offer investments in companies located in other parts of the world, and these companies could also be located in emerging economies. The only company that won't be invested in will be those located in the investor's own country. So this is what the international fund is. Apart from that, we have global funds, and these are funds where the investment made by the fund can be in a company in any part of the globe. So, throughout the globe we can invest. So, that is what global fund is, and they are different from international or foreign funds that we have just discussed, because in global funds investments can be made even the investor's own country, which is not allowed in international or foreign fund. Then we have real estate fund. These are the funds that invest in companies that operate in the real estate sector, and these funds can invest in realtors, builders, property management companies, and even in companies provided loans. And the investment in the real estate can be made at any stage, including projects that are in the planning phase, partially completed, and are actually completed. So, at any stage we can have the scope of investment. Another type of fund under this basis is the commodity focused stock funds, and these funds don't invest directly in the commodity. They invest in companies that are working in the commodities market, such as mining companies or producers of commodities like that, and these funds can at times perform the same way the commodities is as a result of their association with their production. Other types of funds under this specialized mutual funds or on the basis of specialty are the market neutral funds. The reason that these funds are called market neutral is that they don't invest in the markets directly. They invest in treasury bills, ETFs, and securities, and try to target a fixed and steady growth. Then we have inverse or leveraged funds. These are funds that operate unlike the traditional mutual funds, and earnings from these funds happen when the markets fall, and when markets do well, these funds tend to go into loss. And these are generally meant only for those who are willing to incur massive losses, but at the same time can provide huge returns as well as a result of the higher risk they carry. Apart from that, we have asset allocation funds. The asset allocation fund comes in two variants, the target date fund and the target allocation fund. So, these are the two variants in which we are having this asset allocation funds, and these funds the portfolio managers can adjust the allocated assets to achieve the results, and these funds split the invested amounts and invest it in various instruments like bonds and equities. So, these are the mutual funds that we are having on the basis of some specialist or the specialization. We have also gilt fund under that, and these gilt funds are mutual funds where the funds are invested in government securities for a long term. Since they are invested in government securities, they are virtually risk free and can be the ideal investment to those who don't want to take risks. Then we have exchange traded funds, and these are funds that are a mix of both open and close ended mutual funds and are traded on the stock markets, and these funds are not actively managed, they are managed passively and can offer a lot of liquidity. As a result of their being managed passively, they tend to have lower service charges associated with them. So, as they are not managed wholly by the asset managers, they are being charged comparatively lower. So, apart from that, we have few types of mutual funds on the basis of the risk, and that could be a low risk mutual fund, medium risk mutual fund, or a high risk mutual fund. So, if you see, the low risk mutual funds are the mutual funds where the investments made are by those who do not want to take a risk with their money, and the investment in such cases are made in places like the debt market and tend to be long term investments. So, as a result of them being low risk, the returns on this investment is also low, and we can have an example of a low risk fund would be the gilt funds, where investments are made in government securities. They are low risk funds in which we are taking low risk and also we are getting low return. Apart from the low risk, we have medium risk and high risk. Medium risk are the investments that come with a medium amount of risk to the investors. They are ideal for those who are willing to take some risk with the investment and tends to offer higher returns. And these funds can be used as an investment to build wealth over a long period of time. And when we are talking of high risk mutual funds, these mutual funds that are ideal for those who are willing to take higher risk with their money and are looking to build their wealth. We can take an example of high risk funds, and that could be the inverse mutual funds. Even though the risks are high, with these funds they also offer higher returns, as we know. So this is what the types of mutual funds on the basis of risk. So this could be the various types of mutual funds that are available with the asset management companies for the investors. So today we have discussed these various types of mutual funds which are being categorized on the basis of various bases, on the basis of the type of risk, on the specialist basis on which we can have the mutual funds, on the basis of the objective of the investors, on the basis of the growth of the fund that we are requiring, on the basis of the structure, and many more things we have discussed. So in today's class we have a complete knowledge on the types of mutual funds that are available with the asset managers, or we can say that the types of mutual funds that are available for the investors to invest in and to have a well balanced and maintained portfolio of the investment. I hope and believe that you people have understood what we have discussed today. If you have any doubt and query, you can write me in the comment box. For today, this is all. Thank you.